What if I told you there's a retirement account that beats a Roth IRA, beats a traditional IRA, and almost nobody uses it correctly? I'm talking about your health savings account. And here's the kicker. The IRS actually wants you to use it this way. By the end of this video, you'll understand how to turn your HSA into what financial experts call a stealth IRA, and why some people have built six-figure balances using a simple receipts trick. We'll cover exactly how it works, who should use it, real numbers, and the mistakes that can cost you thousands. This is about 12 minutes of your time. Let me tell you about my friend Sarah. She's a software engineer, 32 years old, makes around $90,000 a year. 3 years ago, she switched to a high-deductible health plan to save on premiums. Her HR department mentioned she could open an HSA, so she did. She put in a few $1,000s and just let it sit there in cash. Last year, she had some dental work done, $2,000. She paid it with her HSA debit card, felt good about using pre-tax money, and moved on. Here's what she didn't know. She just made a $20,000 mistake. Not today, 20 years from now. Because if Sarah had paid that dental bill from her checking account instead, kept the receipt, and left that $2,000 invested in her HSA, it could have grown to over $8,000 by retirement, completely tax-free. And she could still pull it out using that same dental receipt decades later. Nobody told her. That's what we're fixing today. So why does this matter right now? Most people treat their HSA like a coupon book. Medical bill comes in. Swipe the HSA card, done. But the wealthy do something different. They treat it like a secret Roth IRA with better tax treatment. And with 2025 contribution limits higher than ever, $4,300 for individuals, $8,550 for families, this is the year to get it right. The strategy I'm about to show you is completely legal, encouraged by the IRS, and shockingly underused. Let's start simple. What is an HSA? It's a health savings account. You can only open one if you have a high-deductible health plan, that's an HDHP. Think of it as a special savings account that comes with 3 tax superpowers. First, the money you put in is tax-deductible. That means it lowers your taxable income right now, just like a traditional IRA. Second, any growth or investment gains inside the account are tax-free. No capital gains tax, no dividend tax. Third, when you take money out for qualified medical expenses, that's also tax-free. That's what we call the triple tax advantage. No other account in the tax code does this. Not a 401k, not an IRA, not even a Roth. Here are the essentials. You need that high-deductible health plan to qualify. For 2025, you can contribute up to $4,300 if you're single, $8,550 if you have family coverage. If you're 55 or older, you get an extra $1,000 catch-up contribution. You can invest the money in stocks, bonds, index funds, just like a brokerage account. And here's the magic part. There's no use it or lose it rule. Your balance rolls over forever. Unlike a flexible spending account, or FSA, which expires each year, your HSA is yours for life. Now, how does the stealth IRA strategy actually work? Here's the step-by-step. First, you open an HSA with a provider that lets you invest, not just hold cash. Fidelity, Lively, HealthEquity, there are many options. Second, you contribute as much as you can afford, up to the IRS limit. Ideally, this comes straight from your paycheck so you also skip payroll taxes. Third, and this is critical, you invest that money. Don't leave it sitting in cash earning 0.1%. Put it in a low-cost index fund like an S&P 500 fund or a total stock market fund. Fourth, when you have a medical expense, and you will, you pay it out of pocket. Use your regular checking account or a credit card. Do not touch your HSA. Fifth, save the receipt. Scan it. Take a photo. Store it in a folder on your computer or use a receipt tracking app. The IRS requires documentation, but here's the thing. There's no time limit on reimbursement. You can reimburse yourself 1 year later, 10 years later, 30 years later. Sixth, let your HSA grow. Over the years, the money compounds tax-free. Seventh, whenever you need cash, maybe in retirement, Maybe for a big expense, you pull out your old receipts, add up the totals, and withdraw that exact amount from your HSA, completely tax-free. You're reimbursing yourself for expenses you paid years ago. 8th, after age 65, if you want to use the money for non-medical stuff, you can. You'll pay regular income tax, just like a traditional IRA, but no penalty. Before 65, non-medical withdrawals get hit with income tax plus a 20% penalty, so don't do that. Let me paint the picture with sound. Imagine this as a pipeline. Money flows in at the top, tax-deductible. It sits in the middle, growing in investments, no taxes on gains. It flows out at the bottom, tax-free if you have receipts. And those receipts are the key that unlocks the exit door, years or decades after you first paid the bill. No other account works this way. How do people actually use this to build wealth? Here's strategy 1. Maximize contributions and invest aggressively. If you're young and healthy, put in the max every year and invest in stock index funds. Don't treat this like an emergency fund. Treat it like your Roth IRA's cooler sibling. Strategy 2. The receipts arbitrage. Every time you have a medical expense, glasses, copays, prescriptions, dental work, pay out of pocket if you can afford it. Keep the receipt. Let your HSA grow. In 10 or 20 years, you'll have a folder full of receipts worth tens of thousands of dollars that you can cash out tax-free. Strategy 3. Front-load in high-income years. If you're in a high tax bracket now, the deduction is worth more. Max out your HSA before you max out your IRA. You save more in taxes today and get better growth benefits long-term. Strategy 4. Coordinate with your spouse. If you're both over 55 and have family HDHP coverage, you can each make catch-up contributions to separate HSAs, boosting your total to $10,550 per year. Strategy 5. Use it as a Roth IRA alternative. Once you hit 65, your HSA becomes almost identical to a Roth IRA for medical expenses, which will be significant in retirement. But unlike a Roth, you got the tax deduction going in. Who should use this strategy? It's best for people in a few profiles. First, middle to high income earners who can afford to pay medical bills from cash flow without touching the HSA. If you're living paycheck to paycheck, this won't work because you need that HSA money now. Second, people who are healthy or have predictable medical costs. If you're spending $10,000 a year on healthcare, you might need to tap the HSA sooner, though you can still save some receipts. Third, long-term thinkers who won't need this money for 10, 20, or 30 years. The magic happens from compounding. Fourth, anyone in a high tax bracket. If you're paying 32 or 35% federal tax, that upfront deduction is worth a lot. Fifth, people who are maxing out their 401k and IRA and want another tax-advantaged space. Let's run the numbers with real examples. Base case. You're 35 years old, single, with an HDHP. You contribute $4,300 per year to your HSA and invest it in an index fund averaging 7% annual returns. You do this for 30 years until you're 65. You contribute $4,300 times 30. That's $129,000 total. But at 7% compound growth, that balance grows to about $413,000. All of that growth, $284,000, is tax-free if you use it for medical expenses. Now, over those 30 years, you've paid roughly $60,000 in medical expenses out of pocket and saved every receipt. At age 65, you can withdraw that $60,000 tax-free, and you still have $353,000 growing. Compare that to a traditional IRA. You'd pay income tax on every withdrawal. Compare it to a Roth IRA. You'd get tax-free withdrawals, but you didn't get the deduction going in, and the contribution limit is only $7,000 versus your HSA's $4,300. Risk case. What if you need money early for something non-medical? Let's say you're 50 years old and you need $10,000 for a home repair. You don't have enough receipts saved, or you've already used them. If you withdraw $10,000 from your HSA for non-medical reasons before 65, you'll pay income tax. Let's say 24%, that's $2,400, plus a 20% penalty, that's $2,000. You net only $5,600. Brutal. That's why you need an emergency fund separate from your HSA. Don't treat your HSA like a piggy bank you can smash. Sensitivity analysis. Let's say you only contribute $2,000 per year instead of $4,300, and your investments return 5% instead of 7%. After 30 years, you've contributed $60,000 total, and it grows to about $133,000. Still tax-free growth of $73,000. Even a smaller, more conservative approach beats a taxable brokerage account because you're getting that triple tax benefit. When should you avoid this strategy or be careful? First, if you don't have a high-deductible health plan, you can't open an HSA at all. Check your insurance. Second, if you can't afford to pay medical expenses out of pocket, don't force it. The strategy assumes you have cash flow. Third, if you're terrible at keeping receipts, this won't work. You need documentation. The IRS can ask for proof years later. Fourth, if your HSA provider charges high fees, that eats your returns. Look for low-fee providers with good investment options. Some HSAs charge monthly maintenance fees, per trade fees, or require minimum balances. Shop around. Fifth, if you're going to need the money in the next 5 years, the market risk might not be worth it. You could invest and then have a downturn right when you need to withdraw. Sixth, non-qualified withdrawals before 65 are expensive. Don't confuse this with a regular savings account. Let's talk taxes and costs. Rules of thumb. Contributions are deductible on your federal return and usually your state return too, though a few states like California and New Jersey don't allow it. Payroll contributions also skip the 7.65% FICA tax, which is huge. Investment gains are tax-free as long as they stay in the account. Withdrawals for qualified medical expenses are always tax-free at any age if you have documentation. After 65, non-medical withdrawals are taxed as ordinary income, no penalty. Before 65, they're taxed plus 20% penalty. Fees vary. Some HSA providers charge $3 per month, some charge nothing. Investment fees depend on what funds you pick. Look for expense ratios under 0.2%. Transfer fees can apply if you switch providers. Read the fine print. Here's your 7-step action checklist to get started this week. Step 1. Confirm you have a high-deductible health plan. Call your HR or check your insurance card. For 2025, that means a deductible of at least $1,600 for individual coverage or $3,200 for family. Step 2. Open an HSA with a provider that offers investing, not just a savings account. Fidelity and Lively are popular low-fee options. Step 3. Set up automatic contributions from your paycheck if your employer allows it, or set up a monthly transfer from your bank. Step 4. Once you have enough balance, invest it. Most providers require a minimum, often $1,000 or $2,000, before you can invest. Put the rest in a low-cost index fund. Step 5. Create a system for saving receipts. Use a Google Drive folder, a scanner app, or a spreadsheet with photos. Label each receipt with the date, amount, and type of expense. Step 6. Start paying your next medical expense out of pocket instead of using your HSA card. Step 7. Bookmark the IRS list of qualified medical expenses. You can find it in IRS Publication 502. This includes way more than you think. Copays, prescriptions, dental, vision, chiropractors, even some over-the-counter items. Let's recap with a new angle. Remember the question at the start? Why does almost nobody use their HSA correctly? Because it requires delayed gratification. We're wired to use the tool right in front of us. Medical bill arrives, HSA card is right there, swipe, done, dopamine hit. But the wealthy think differently. They ask, how do I maximize the tax-free growth? And the answer is, don't spend it now. Let it grow. The receipts strategy flips the script. You're not saving for future medical expenses. You're creating a pile of tax-free money that happens to be unlocked by past medical expenses. It's a retirement account in disguise. The IRS built this loophole on purpose. They want people to save for healthcare. But they didn't put a time limit on reimbursements. That's the gift. Let's hit some common questions. Can anyone open an HSA? No. You must have a high-deductible health plan and no other disqualifying coverage like Medicare or a general-purpose FSA. Do HSAs have use it or lose it rules? No. Your balance rolls over every year forever. It's yours until you spend it. How do I prove expenses years later? Save receipts, EOBs, or credit card statements showing the charge and that it was a qualified medical expense. Store them digitally and back them up. What if I spend HSA money on non-medical costs before 65? You'll pay income tax plus a 20% penalty. After 65, just income tax, no penalty. Are investment gains taxed? No, as long as you withdraw for qualified medical expenses or wait until after 65. Can I invest my HSA funds? Yes. Most major HSA providers offer mutual funds, ETFs, and index funds. Not all do, so check before opening. What's the catch-up rule? If you're 55 or older, you can contribute an extra $1,000 per year. Is it better than an IRA? For many people, yes, because you get a deduction going in, tax-free growth, and tax-free withdrawals, versus an IRA where you pick two of those three. Here's the disclaimer. This video is for educational purposes only. It is not financial advice, tax advice, or legal advice. Everyone's situation is different. Contribution limits, tax rules, and investment risks can change. Consult a qualified financial planner or tax professional before making decisions. Past performance of investments does not guarantee future results. I am not your financial advisor. The HSA Stealth IRA strategy works because the IRS gave you a tool, and most people use it like a hammer when it's actually a Swiss Army knife. Max your contributions, invest the balance, pay expenses out of pocket, save receipts, let it grow, reimburse yourself decades later. Triple tax advantage, no time limit, and almost nobody's doing it. Now you know. If you want the checklist and links to low-fee HSA providers, drop a comment. And if this clicked for you, share it with someone who's leaving money on the table.